Hey everyone, welcome back to Corporate Decoder. Today we're diving into a document about Agriculture and Natural Solutions Acquisition Corporation. Let's just say they're looking to extend their runway and it involves a bit of a maneuver around their charter, which is always fun to unpack, right? Stick around. So what we're looking at here is a preliminary proxy statement. Think of it as a heads up to shareholders about a big meeting where they'll be voting on some important changes. The company basically needs more time to find a business to merge with, or as they call it, a business combination. Their original deadline was November 13, 2026. This is pretty common for these special acquisition companies, often called SPACs. The main event here is proposal number 1, the extension amendment proposal. This is where shareholders get to vote on whether to change the company's official rules called the amended and restated memorandum and articles of association to give them that extra year. If this doesn't pass and they haven't found a business to combine with by the original November 2025 deadline, they'll have to shut down and liquidate. That means shareholders would get back whatever they'll have just left in their trust account, and any warrants would likely be worthless. Now, because they're asking shareholders to approve this extension, they have to give those shareholders a choice. Anyone holding public shares, which are the shares sold to the public during their initial offering, can choose to redeem their shares. This is basically asking for their money back from the company's trust account before the extension happens. It's a way for shareholders who don't want to wait any longer to get their investment out. Here's an interesting detail. If shareholders vote yes to the extension, the company's sponsor or someone related to them is going to put more money into the trust account. They'll do this by giving the company a loan, essentially through a promissory note which doesn't earn any interest. They'll do this monthly up to a certain maximum amount. This is to help ensure there's enough money to cover any redemption shareholders might request. If the sponsor doesn't do this, the company's board plans to just wind down and liquidate. This shows how critical the sponsor's support is. Enough money to cover any redemptions shareholders might request. If the sponsor doesn't do this, the company's board plans to just wind down and liquidate. This shows how critical the sponsor's support is. Enough money to cover any redemptions shareholders might request. If the sponsor doesn't do this, the company's board plans to just wind down and liquidate. This shows how critical the sponsor's support is. The document mentions the redemption price per share around August 2025 was about $10 per share. So if shareholders are $10 at $10 per share, so if shareholders are redeeming their shares, they're getting back their initial investment plus any interest earned in the trust account minus some fees like dissolution expenses. Let's be crystal clear about what happens if they don't get the extension approved. The company will stop everything except winding down. They'll have to redeem all those public shares and then they'll officially dissolve and liquidate. That's a pretty stark outcome. Now, for the voting requirements, to approve this extension, they need a special resolution. This isn't just a simple majority. It requires at least 2/3 of the votes cast by shareholders who can actually vote. This means getting a pretty strong consensus from the shareholders. The company's initial shareholders, which basically means the folks who got the shares before the company went public, including the sponsor, are expected to vote for the extension. They actually own about 20% of the company's shares. This is a big chunk and it significantly helps their chances of getting the 2/3 majority they need. However, they don't have redemption rights for their own shares, so their interests are tied to getting a business combination done. This is a key risk factor. Even if the shareholders approve the extension, there's no guarantee the company will actually find a good business to combine with before the new deadline. They're still out there searching, and the market conditions can change a lot. Here's another important point. The company is trying hard not to be classified as an investment company under a specific US law. If they were classified that way, it would mean a lot more rules, paperwork, and restrictions, which could really slow down or even stop their ability to find and merge with a business. So they're careful about how they invest the money in their trust account, mostly keeping it in very safe short-term government securities. Let's look at the numbers for approval. For the extension amendment proposal, which needs that 2/3 majority of votes cast, they need about 20.1 million additional public shares to vote for it if all public shares are voted. If only enough shares to meet the quorum show up, they still need about 958,000 public shares to vote for it. For the adjournment proposal, which needs a simple majority, they need around 12.9 million public shares if all are voted. Without the sponsors' votes included, getting the public shareholders on board is crucial. Looking at who owns the company, we see some major institutional investors like the Goldman Sachs Group, Glazer Capital, and others holding significant chunks of the Class A shares. the sponsor, Agriculture and Natural Solutions Acquisition Sponsor LLC, and its key people like David Leishan hold all the Class B shares. These Class B shares usually have more voting power, and as we saw, they're expected to vote for the extension. The company's board is clearly recommending a for vote on these proposals. They believe extending the deadline is the best way to try and complete a successful business combination, which they think will benefit everyone involved. So what's my take on all this? Agriculture and Natural Solutions Acquisition Corporation is in a pretty typical SPAC situation, needing more time to find a deal. The extension is logical for them to avoid liquidation, and the sponsor's financial backing, along with their expected for vote, gives them a solid chance. The key risks are simply not finding a suitable target within the new time frame, and the potential for a large number of shareholders to redeem their shares, which would reduce the capital available for a business combination. The big focus here is on those initial shareholders and whether enough public shareholders will vote to approve the extension, showing confidence in the company's search for a business to merge with. It's a waiting game, and shareholder support is vital for them to keep playing. Alright, that's our breakdown of Agriculture and Natural Solutions Acquisition Corporation's proxy filing. What's your take on these numbers and these proposals? Do you think they'll find a good business to merge with in this extra year? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more corporate deep dives like this. Don't forget to check out our Discord community in the description. We've got a great group discussing these filings. Thanks for watching, and I'll see you in the next video.